nothing to get excited about. We think we're going to continue to muddle along and everything will be fine. So I want to switch gears now and talk for just a few minutes about key factors to a successful investing experience. And so the things that people do that leads to a good investing experience, i.e. making money, is number one, have a goal, manage risk. When you take on risks, take on those that you may actually make money at. Expenses are important, and to be disciplined in your investment approach. So the whole point is, why are you investing? Is it for retirement, to build family wealth, or a legacy, for education, for another home? Whatever your goals are, it's very important to know why you're investing. If you're just investing without goals, and it's very difficult to be consistent in what you're doing. It sort of shows up as a kind of a willy-nilly sort of thing. Yet, when we see people who have clear goals, then it helps drive the investment strategy, and you can measure what's going on with your investments. And when you look at making changes, how does that play into your goals? The second part is managing risk, and I want to talk about a couple of risks to investing. The first one is, to kind of frame this all up, is unsystematic risk. Those are risks that are specific to that investment that you're making, that company, stock, piece of real estate, that sort of thing. Those specific risks that are related to them. How good is the management? How leveraged are they in a good market? How well are their products positioned? What's their pricing? All that sort of thing. The second risk I want to talk about is systematic risk. And are those risks that relate to the whole market. For example, the stock market or the real estate market. When the tech bubble burst at the beginning of this century, at the beginning of last decade, it really didn't matter whether you had a good tech stock or a bad tech stock, or in the stock market, whatever stock it was forever. Whatever. It didn't matter what stock you had. It pretty much went down. And in the 90s, when the stock market was in an incredible rush up, it didn't matter what stock you had. It pretty much went up. Same thing with the real estate market. From 2000 to 2007, it didn't make much difference what kind of housing you owned. It went up. Some went up more than others, but they all went up. And for the last 4 years, it hasn't mattered much where your house was. It's not worth as much as it was 4 or 5 years ago. Some dropped more than others, but they all dropped. That's what we're talking about, systematic risk. So now I want to talk about, how does one manage those sort of risks? So to manage unsystematic risk, or that risk specific, the way you reduce that risk is through diversification. That is, you buy a whole bunch of them. If you own 500 stocks and one of them has problems, it may have little or no effect on the overall performance of the fund. So that's how we reduce unsystematic risk, is through diversification. How do we manage unsystematic risk? Through asset allocation. You've all heard us talk about, and you've read about asset allocation, I'm sure, and heard it. It's kind of out there. So we invest in different types of investments that tend to act differently in different environments. If we set aside 2008 and early 2009, when basically everything went down, that was a very unusual circumstance. Under normal circumstances, things operate in different ways. Good example of that was in 2000 through 2003, when the technology bubble burst and stocks went down in value while real estate was going up in value. In the early part of the 1990s, the stock market was on a tear and real estate values were pretty flat. Just kind of a simple example of that. So here's the example of investing in different kinds of things. The next point I'm going to talk about risks that can pay off. In other words, what does research indicate do you find those things where when you take on a little risk, you can pretty much count on being paid for it over time? The example I'm going to use is in the stock market. Research by Gene Fama and Ken French from 1992 and 1993. They published some papers about 3 factors where investors are paid for the risks that they take. When we talk about risks, there's some additional volatility there, and that there's actual profit available for doing that. I remember when this first came out, how exciting this was. I remember taking classes and learning about it, and when I was teaching investments through the College of Financial Planning and through UC Davis, this was one of the things we taught was the Fama and French research. So the 3 factors are, when you invest in the stock market versus the bond market or cash, you can expect over time that you will be paid for that. You will get an additional rate of return for the fact that you're in the stock market, that the stock market does actually earn more than bonds or cash. The second factor is that when you look at the rates of return of different types of stocks, if you took the smallest companies to the biggest companies and you put them on a scale of 1 to 10 by size, or in 20% increments into 5 slices, however you want to do it, consistently, smaller companies will get a better rate of return than large companies. And the third factor is value, and they measure value by price to the book value of the companies. And again, if you take the stock market, regardless of size, if you take any stock market and you divide companies by value, in that on one side is the lower book to value companies and the other side are the higher book to value companies or the growth companies, that consistently over time there is a premium, there is an additional rate of return you earn by investing in value companies. So this is something that we've always done in all of our portfolios, is that we have had a tilt toward larger amount in small companies than the market has, and more of a value tilt than the market as a whole. The next factor I want to talk about is expenses. That costs do matter, and there's 3 components to this. One is trading cost, that is, what does it cost to buy and sell the securities? And if you and I are buying a stock, even if we're using E-Trade or somebody who has very low trading costs, because we're not buying that many shares, we're going to pay more than an institutional investor that's buying tens of thousands or hundreds of thousands of shares. They can get a lower trading cost. The second factor is management fees. That is, what does it cost to pay for professional management to do that? And for us in mutual funds, that's the mutual fund management fee that we're primarily talking about there. So we're we want to keep management fees low. And then the third part of costs has to do with the bid-ask spread. When there's a trade, whether it's a stock or a bond, between the buyer and the seller, they don't pay the same price. There is a spread. The buyer pays more than the seller gets. The difference there is what we call the bid-ask spread, and that goes to the market maker or the entity that's matching up the buyers and the sellers. There's a spread there. Again, the larger the volume of trading you're doing, the lower the bid-ask spread is, and so it's something that we want to pay attention to when we're looking at cost. What are the managers getting as far as the spreads go? And the last factor I want to talk about is to be disciplined, to stick to your strategy. There's no academic evidence whatsoever that anybody can time the market consistently enough to beat the market. And by that we mean go in and go out, when to buy and when to sell. A recent study by McGraw-Hill's Financial Communication shows why. They looked at 5,040 trading days between 1990 and 2010. If somebody was fully invested for the full 5,040 days in the S&P 500, they would earn a little over 9%. If they just missed the 10 best days, then they only got 5 1/3. If they missed the best 20 days, they earn less than 3%. And out of over 5,000 days, look at this, if they were in the market 5,010 days, but they missed the best 30, they earn less than 1%. And when are the best 10 days going to be in the next 5,000 trading days? We don't know. It could be tomorrow. It could be happening today. We just don't know. So that's why we don't try to time it. We just, when we're in, we're in. Another interesting thing is there's research that shows that mutual fund investors actually earn less than the mutual fund did. The first study that looked at this was done by Martin Zweig and Morningstar in 1994, and they found that during the 5-year period, 89 to 94, while the average mutual fund, stock mutual fund, earned 12.5%, the average investor only earned 2.2%. Why is that? Because the investor bought after the fund went up because it had a great rate of return, and then they bailed when it had a bad year. At the same time, in 1994, Dalbar started doing an annual study that's well quoted and used around the investing universe called Quantitative Analysis of Investor Behavior, and it confirmed these results. They've been doing the study for over 20 years, and the 20 years ending in 2009, the average investment return for 20 years was 8.2%, but the average investor only earned a little over 3%. So to quickly review, the important things to have a good successful investing experience or rate of return is know why you're investing, manage risk through diversification, asset allocation, invest in those areas where you can actually make money, which is have money in the stock market, in smaller companies, and in value type companies. Keep an eye on expenses and be disciplined. Don't run away when it looks bad, and don't double down when it looks good. It's already too late at that point. So that kind of concludes my part of the presentation today.